Good afternoon, honorable judges. We are Team 14, and we are here to initiate a buy on a Sotspa for 40 Thai baht with an upside potential of 18.5% and implied exit of 24.4 times. We believe OSP has a promising market internationally offering its premium products. Not only that, secondly, the company has a strong potential market for the functional drinks. And lastly, OSP's intensive cost-saving program and committed ESG put it in a great spot against its competitors. These three factors are supported by our DCF modeling and relative evaluation that will be handled by Kunanon.
Thank you, Hamza. So, to expand more into the first one about growing internationally, given the current domestic market dominance for OSP in the energy drinks function, we believe that the future potential growth of the energy drinks market lies outside of Thailand, particularly in the CLMV regions. As you can see from the table here, the company's international revenue contribution has been growing since the past 2 years. Secondly, regarding its domestic growth, we believe that this growth will be driven by the company's rising star brand CFIT in the functional drinks market. As you can see, it has grown exponentially since its inception in 2012, and thus also contributing to the company's functional drinks market share, which has grown since 2018 from 25% to 39.8%. And also with the announcement of a new exciting product, the CBD drinks with its partners, we believe that this new exciting prospect could potentially boost the company's functional drinks business segment and capture more of the domestic market share. And last but not least, regarding the company's cost-cutting initiatives, the Fast Forward 10X, which is a new, more intense version of the current one that fit Fast Forward, we believe that the Fast Forward 10X should be able to potentially replicate and even exceed the results of the past cost-cutting initiative, and thereby further enhancing the company's already very strong bottom line. And thus, with these 3 points, international growth, domestic functional growth, and cost control, we believe it supports our buy recommendation for all sorts of path. Back to you, Hamza.
Thank you, Kunanon. Now talking about the industry overview. OSP dominates the energy drink market with a 54.5% total share. Not only that, but the company has a strong international positioning into the CLMV region as well, particularly in Myanmar. Now when we talk about the domestic functional market, CVIT is in a position to take the prime #1 spot against its competitors. Not only that, but considering the cannabis world market in Thailand, the introduction of CBD products will be a game changer for OSP. The company also continues to offer personal and healthcare products that shows business continuity. Now let's move to the company's overview. Now again, OSP is a major player into the energy drinks market in Thailand. Not only that, but the company has a multi-brand portfolio offering beverages, personal, and healthcare products. However, the main revenue driver for OSP is its energy drinks market. Their follow-up revenue driver is their functional drinks, which is further enhanced by their contract with Japan House Food and Yanhee Brew. Not only that, but the transitioning of from a family business to a multinational handled by management team is a great point for the investors to build credibility. With that being said, I'll be handing over to Kunanon for the financials.
Thank you, Hamza. So, regarding the company's financial analysis, currently it exhibits a resilient bottom line, a robust balance sheet, and ample cash flows. And these are the 4 points that I'll be going into more detail. So first, the company has shown commendable resilience against the impacts of COVID-19. It has netted an overall growth of 3.2% in 2021. This is in spite of its domestic underperformance. In fact, the company reports outstanding results for its international business segments and OEM, thus further supporting our belief that the international market is where the company's potential lies. Secondly, regarding the current performance of the Fit Fast firm, it continues to save the company costs and strengthen their profit margins. It has shown success previously in years since 2014. As you see in the graph here, the company's costs have gone down, and in turn, the company's profits have gone up overall. We thus further believe that the Fast Forward 10X should be able to surpass their cost-saving goals. Regarding the company's balance sheet, OSP continues to report a very robust balance sheet. As you see in the chart here, there weren't any major changes to the company's balance sheet, but the company reports a net to debt equity ratio of negative 0.02 times, meaning that the company should be able to finance any large investments they wish to take through leverage if they choose to do so. Moving on to the cash flows, the company still generates more than enough cash flows to fund all of their business requirements of their operations, as you can see in the chart here for the past 3 years. And thus, and one of their main capital expenditures currently is their 1 billion Thai baht maintenance capital expenditure. We also further believe that the company should have the ability to fund any minor investments that they may take through their OCN organically if they wish to do so. And thus you can see that the company is secure, financially secure, and then state that their preparation for any future activities they wish to take. Back to you, Hamza.
Thank you, Kunano. Now the evaluations will be handled by Nathapong.
Thank you, Hamza. Within the evaluation, there are two approaches. We support all of our recommendations. First, breaking into the fundamental approach, DCF, which based on the two-state CFF, proposed our target price of 40 Thai baht. We use 5.5% back at discount rate and 2.3% as terminal growth within the average of Thai GDP growth rate during the past 7 years, to imply that also supply should grow similarly as economic growth in the long term. Next, a line chart on the left represents the historical net profit margin, which has a CAGR of 20.6%. We have projected future NPM to increase, having a CAGR of 9.5% due to 3 different catalysts as shown on the slide. And next, we have projected revenue breakdown as shown on the left, that we believe the beverage segment should continue to increase its revenue contribution as clarified in percentage on the right. An increase is due to that also supply had and should continue to capture higher beverage market share, mainly from the energy and functional drink. Hence, we believe our fundamental valuation support a positive upside of 18.5%. Next, in the relative valuation, also supply is trading relatively cheap compared with its historical sale, which has an average PE of 32.93 times. Likewise, its PBV is currently being in the cheap range. In comparisons among peers on the right, we believe also supply should be trading with an implied exit PE of 24.4 times, not deviating much from an average PE of F&B industry at 23 times. However, with premiumization due to its leading position in domestic and regional market, along with potential growth from 3 mentioned catalysts, we believe also supply should be trading at the valuation closer to the global peers. Now, our two approach, our valuation propose a sweet spot to buy also supply. Passing back to Hamza.
Thank you, Nathapong. Now we'll be talking about the risks, and that will be handled by Raja.
Thank you, Hamza. So when it comes to investment risk, we have assessed 6 risks that may have impact on the company's valuation. The first risk is product execution, as the company may not be able to replicate its business success into the new products, especially the CBD products. Second, fast forward 10x, or the cost-cutting initiative may not go as planned. Third, raw material price fluctuation, especially sugar, which is the main ingredient. Fourth, natural gas price fluctuation related to the bottling business. Fifth, the Myanmar fiat fluctuation, as roughly 11% of the company's total revenue come from Myanmar. And lastly, the Omicron variant, which may delay the company's recovery and any new initiative. Now let's move on to the result of scenario analysis. As you can see from the risk matrix that product execution has the highest risk with a moderate impact on company's valuation. For the first scenario is if the company is able to launch their product in 2022, it will result in a positive 6.51% on target price. And for the second scenario is if the company has to delay the product execution, it will result in a negative 3.62% on target price. And as of the Myanmar fiat fluctuation and Omicron variant, the impact is lower than 2% on target price. And that's it for investment risk. Back to you, Hamza.
Thank you, Raja. Lastly, we'll be talking about ESG, and that will be handled by Paniakan.
Thank you, Hamza. So for the ESG, we believe that good ESG initiative should be win-win, and it should benefit companies through these 3 aspects. First, increase revenue. Second, lower cost. And third, mitigate risk and protect company reputation. In this following table, we demonstrate the activity that OSP engages in ESG in the past few years, and these activities could affect the stock price. Supported by our calculation using the sensitivity analysis, the result is 1% increase in revenue caused by ESG initiative will increase 1.8%
considering these three factors, y'all should open your financial platform and buy
Thumbs
OSB.
up.
Thank you.
Okay, my first question is about the raw material price. I think commodity price, like the cereal gas price will rise this year. So what is your current assumption about your raw material price, and why do you think the cost cutting program could outweigh the rise of commodity price and raw material price in 2022? Because I think like your profit margin is
Right. So the total expense that we have projected and the related with the raw material price, we assume the historical, and then we forecast by spreading it out in percentage of sales. And we have seen the trend that is being decreasing down, and that we assume the same concept as of now. Also, has the total expense as a percentage of sales equals to around 64%, and we apply the same decrease, like 1% in each year. And after the result we got, it
let me clarify the question. I think what he is asking is that you project the cost, the cost of goods sold is down,
Right.
but it seems that the inflation is making the raw materials price increase. So I think this is a reason why we are questioning your projection.
So, yeah.
I think it's okay, let's move on.
Yes, we don't have an answer for that one. But one thing I can comment on is that based on the trend of the Fast Forward program, we believe that the Fast Forward 10X should be able to replicate their success in reducing their costs. Where we can't reply to you all regarding the raw materials conference. So.
I've got some questions on your valuation. Why did you come up with a higher cost of debt versus cost of equity, 7.7% versus 5.0%?
We
How
received-
did you get those numbers?
We received that accounting items in the report years that we have used the total debt, taking account with the cost of equity. So let me clarify on the cost of debt and cost of equity. The cost of equity we calculated from the risk-free rate of 10-year government bond, and we use the RM as 5% from the historical 11 years of the set, and we use the beta as 0.93 times, and the cost of debt we use the total debt with the weighted that we have calculated, and it comes out as 7.7%.
Okay, it's okay. So let me ask another question. What is the DE ratio?
The DE ratio is roughly around 0.2 times.
But why you come up with a higher cost of debt versus cost of equity? Since every $1 of equity has only 20 cents debt, right?
Right.
But why cost of debt is so high, much higher than cost of equity?
Right. So we have used the information as reported, and the numbers that we have calculated come out as we have reviewed. And we still believe that the company still have room for the leverage in the future.
How much debt you have assumed going forward?
The debt that we have assumed going forward is roughly around the same as the reported year.
Same, so no
No,
increase?
I mean, the same range, within the same range, not deviating much from the average, because our valuation is calculated with supported with the average information from the historical years since 2014, and we use the average to project the future projection.
Why don't we choose to use the DCF valuation and by divided into two steps?
Because we believe the fundamental is the key thing that investor would want to invest in company. And in the relative valuation, investor might want to know when should they invest in the company. We have some criteria and projection so that, like the PE and PBV, so investor could know this is the right time to buy or this is not the right time to buy. We have compared with the historical sell and use the average line to compare it. And the reasons behind the DCF, we believe also Sapa has a cash flow management with a great management team that they can manage the cash flow through the pandemic years and keep it along in the future years.
Let's move to the, I think it's going to be easier question. You talk about quite interesting stuff like the premiumization. Can you elaborate more on this one? The premiumization, the price point of its premium product compared to the current product. How much about the price point? How much it increase, gonna increase, and is this gonna affect the top line growth? How much it gonna affect it?
As refers at the premiumizations, we refers as its leading position, and we have projected the future product as CBD related product. So we take that into account. So we think that after we have discussed with the meeting with the company, and we believe they convey the message that this expansion into CLMV CBD related product could contribute more, having also supplied to gain some premium.
So you're not talking about the like a new premium product?
No.
It's just the new kind of product.
Right, right.
Have you factor the hemp or CBD in your model?
Right, yes,
And
yes.
what is the contribution for the bottom line?
We have
1 minute left.
we have projected a CBD related product similarly as the CBD, but we believe that also should not start over again with the new product, as CBD could be the variant of the functional drink. The functional drink has grown double, like 1,000, then 2,000, and we believe the CBD related product could having the same concept of growth with that, and that the consumer has already known of the functional drink from also Sapa. And we think this is a strong key that also Sapa could capture the higher market share, and the numbers that we have projected CBD related product is 1,000 million baht in 2012 and then double onward to 2025, which
Time's up.
Thank you.
Now the judges can proceed with their recommendation and comments.
A lot of comment from me. But, the first one is that you need to recheck your concept of the cost of capital. Basically, the cost of debt shouldn't be higher than